The most powerful moves in history never arrive with noise. They arrive with silence. And right now, silver is silent because something enormous is holding it in place. There is a principle known to intelligence agencies around the world: the threats that speak the loudest are rarely the ones that do the most damage. Real danger doesn't shout. It waits. It blends in. It absorbs. Financial markets operate on the same psychology. Traders are trained to watch for fireworks, explosive rallies, dramatic collapses, screaming headlines. We associate motion with meaning. We assume stillness means nothing is happening. But sometimes stillness is the clearest signal you will ever get. That's exactly what we are seeing in silver right now. For weeks, price has hovered in the low 60s. It drifts down slightly, then halts. It nudges upward, then freezes. There is no momentum, no breakout, no collapse. To the average observer, this looks like exhaustion. It looks like a rally that ran out of fuel. It looks like boredom. Many have already tuned out, convinced silver has lost its edge. That conclusion couldn't be more dangerous, because when you look beneath the surface, when you stop watching price alone and start watching volume, order behavior, and time of day activity, a completely different story emerges. This market is not asleep. It is under siege. Enormous amounts of paper are being dumped into silver every day, yet the price refuses to fall. That doesn't happen by accident. That only happens when a buyer with extraordinary resources is standing underneath the market, absorbing everything without flinching. Banks have tried to push silver lower. Algorithmic systems have unloaded supply. Short pressure has been relentless, and still, the price will not break. This tells us something critical: someone is defending this level, not to make a quick profit, but to accumulate as much metal as possible without alerting the market. This is not a speculative frenzy. It is not a retail squeeze. It is not social media excitement. It is structured, disciplined, institutional accumulation, and the size of it suggests a player powerful enough to permanently alter the silver market's balance. To understand why this matters, you have to understand how large money operates. When individuals buy silver, they click market buy and accept whatever price the market offers. But when an entity wants hundreds of millions of dollars worth of metal, millions upon millions of ounces, that approach is impossible. Market buying would cause prices to explode instantly, destroying their own entry and alerting the world. Instead, they use strategy. Institutions rely on iceberg orders, algorithmic structures where only a small fraction of a massive order is visible at any moment. 5 contracts appear in the book. When those contracts are sold, they instantly reload. Again and again. To sellers, it feels like infinite demand. To price, nothing changes. It stays pinned. Meanwhile, volume surges relentlessly. This is precisely the behavior we're witnessing now. Every attempt to push silver below the current range hits an invisible barrier. Price doesn't bounce, it simply stops. That is not normal market behavior. Based on recent turnover, it is reasonable to conclude that a single entity has already absorbed somewhere between 10 and 15 million ounces of silver. That represents roughly $650 million to over $1 billion in capital deployed quietly, methodically, without urgency. That alone rules out most potential buyers. Retail traders don't have that kind of capital. Hedge funds typically avoid long-term commodity accumulation and prefer liquid exits. Bullion banks historically sell into strength. They do not defend price floors. The footprint we're seeing belongs to a strategic end user, a buyer who needs silver not as a trade, but as a requirement for survival. This is not speculation. This is procurement. The longer this flat price action persists with elevated volume, the more explosive the eventual move becomes. What we are witnessing is a transfer of ownership. Nervous holders who bought lower are selling out of boredom or fear. Long-term entities with multi-year horizons are absorbing every ounce offered. This process is essential. It builds a foundation. Markets that rise without this foundation collapse. Markets that pause to build it don't. That is why this moment matters so much. In previous silver cycles, sharp rallies were followed by violent crashes because they were driven by paper enthusiasm. When excitement faded, demand vanished. Today, excitement is already gone, yet price remains firm. That tells you demand is no longer optional. Someone must buy, regardless of headlines or sentiment. Many skeptics ask whether this could simply be banks covering short positions. It's a fair question, but the data strongly argues against it. First, timing. Bank activity tends to cluster around specific liquidity windows, daily closes fixings, or major announcements. What we are seeing now is constant buying across all sessions: Asia, Europe, and US pre-market. That is not panic covering. That is disciplined algorithmic accumulation designed to minimize market impact. Second, physical premiums. If this were only paper positioning, physical and paper prices would converge. Instead, the opposite is happening. Physical premiums are rising even while paper prices stall. That only occurs when metal is being removed from circulation. Third, correlation shifts. Silver is no longer trading as a monetary asset alone. It is beginning to move alongside industrial metals tied to electrification and energy infrastructure. That tells us the buyer is industrial, not financial. So who fits this profile? Who has tens of billions in cash, enormous energy needs, and zero tolerance for supply shortages? Big technology. The companies building artificial intelligence infrastructure at a scale the world has never experienced. Their challenge isn't software. It isn't chips. It is electricity. AI consumes energy at an entirely different magnitude than traditional computing. A single advanced AI query can require many times the energy of a standard search. As models improve, that demand grows exponentially. The global power grid is not prepared for this. Much of it is outdated, overstressed, and already operating near capacity. So the tech giants are doing what rational actors do when infrastructure fails to keep up. They are building their own. Data centers require reliable, scalable, and politically acceptable energy sources. Fossil fuels are increasingly restricted. Nuclear takes too long to deploy. Wind lacks reliability. That leaves solar as the only scalable option, and high-efficiency solar cannot be built without silver. This isn't a theory. It's physics. Recent infrastructure partnerships and capital commitments make this visible. Tens of billions are being allocated not just to servers, but to the energy systems required to run them. When you compare those budgets to the total annual value of global silver production, the imbalance becomes obvious. A single corporate fund can rival the entire mining industry's yearly output. Efficiency gains do not solve this problem. As solar becomes more efficient, it becomes cheaper and more widely deployed. Cheaper energy increases consumption. AI data centers operate 24/7, which means solar systems must be massively overbuilt to store power for nighttime operation. For every unit of computing demand, multiple units of generation capacity are required. The math does not work, and when math doesn't work in a commodity market, prices must adjust. That's why accumulation is happening now, before shortages become visible, before prices reflect reality. This buyer is not chasing upside. They are securing availability. Price is secondary. This behavior marks a broader shift in corporate strategy. For decades, companies relied on just-in-time supply chains. That model collapsed when disruptions exposed its fragility. Today, control over raw materials is a strategic advantage. We are seeing a return to vertical integration, ownership of inputs rather than reliance on markets. And once this silver is removed, it does not return. It disappears into private inventories, off-exchange, and outside reported systems. Invisible supply removal, dark stockpiles. The market sees what remains, not what has vanished. Which brings us to consequences. Silver production is finite. If hundreds of millions of ounces are redirected toward energy and AI infrastructure, other sectors are crowded out. Medical technology. Defense systems. These industries cannot substitute silver. They are price inelastic. They must buy, regardless of cost. That sets up conflict, not between investors, but between essential systems. Healthcare versus technology. National security versus corporate expansion. Jewelry and decorative demand become the pressure valve as higher prices encourage scrap recycling. But scrap flows slowly. Cultural assets are not liquidated overnight. This mismatch creates overshoot. For individual holders, the strategy is not to fight this process. It is to align with it. Flat prices are designed to exhaust patience. Boredom is the trap. As long as volume remains elevated and price holds, accumulation continues. Eventually, it ends. When the buyer finishes, the floor disappears. But so do the sellers. Price does not climb, it gaps. Resistance vanishes. Historical volume profiles show very little supply above current levels. Once key thresholds break, the market enters a vacuum. That phase is fast, emotional, and violent. Gains arrive quickly. The challenge is not entering early, it is holding through success. Selling too soon feels safe, but exchanging scarce assets for weakening currency at the start of a structural shift is how wealth is transferred away. This is not about trading silver. It is about understanding what it represents: energy, infrastructure, and strategic necessity. The market is not broken. It is being prepared. The buyer holding the line will not announce when they are finished. You will only know after the price moves. Until then, silence is the signal, stillness is the warning, and boredom is the test. The loading phase is nearly complete.